Welcome to the Deep Dive. We're digging into the data that moves markets, and today, well, it's Medpace, ticker MEDP, and their Q3 2025 earnings call. The market reaction was pretty explosive. It really felt like a total reset on how people were thinking about demand, not just for them, but maybe the whole sector.
Absolutely. That's the real story here. This wasn't just good numbers. It felt like a confirmation signal. We've been waiting for signs of a real industry upcycle, and well, before this call, there was definitely some nervousness, right, about demand maybe softening.
Yeah, those booking wobbles earlier in the year had people talking.
Exactly. So Q3 didn't just calm those fears. It pretty much showed that the forward indicators are looking solid. Suggests a pretty healthy path into 2026.
Okay, let's get into the specifics then. The numbers that really kick things off. It was a solid beat across the board. Diluted GAAP EPS, $3.86. That was well above the $3.53 consensus.
Right, a nice beat there. And you saw that paired with really strong top-line growth, too. Revenue hit $659.9 million. Again, comfortably ahead of what people expected. That's what, 23.7% growth year over year? Pretty impressive.
And operationally, margins looked okay.
Yeah, they held things together. EBITDA margin came in at 22.5%. Actually, ticked up just slightly from 22.3% last year. So good efficiency alongside that growth.
But I think, the number everyone was really zeroed in on was new business, the pipeline.
That's it. This is where you saw that the reacceleration everyone hoped for. Net new awards were $789.6 million. Just huge.
And maybe just quickly clarify for folks listening, net new awards, that's the value of new contracts signed, right? Minus any cancellations in the quarter.
Precisely. And that $789.6 million translates into a 1.2 rounds book-to-bill ratio, which is massive.
1.2, yeah.
This is the number. This reacceleration, up almost 48% from last year, by the way. This is what tells you the demand environment isn't just stable, it's growing strong again. It kind of moves the conversation past the worry stage, into, okay, how do they execute?
Right. Okay, so let's dig into that execution piece. Starting with the backlog itself. The ending backlog figure was $3,000.6 million. That's $3 billion, up about 2.5% year over year. Seems kind of modest.
Yeah, on the surface, 2.5% growth doesn't sound huge, but you got to look at the speed, the velocity. The really telling number here was the backlog conversion rate, how fast they turned that backlog into actual revenue.
Okay.
It jumped up to around 23% in Q3. That's way up from roughly 18% this time last year.
So they're burning through that backlog much faster.
Exactly. That's the key. Faster burn means the work they have is translating to revenue more quickly.
Got it. But I think the real focus on the call, the thing that got a lot of airtime, was this idea of future visibility. Management kept talking about something they call the pre-backlog.
The pre-backlog.
This is work that's been awarded, signed, but isn't officially in that main $3 billion backlog figure yet.
Right. And the crucial thing they said is that the total dollar value in this pre-backlog bucket is up about 30% compared to last year.
30%?
Yeah. And why this matters so much is it kind of reduces the worry about a potential slowdown or an air gag in revenue growth heading into 2026. This pre-backlog includes work that's awarded, fixed scope, but maybe hasn't hit that first patient-in milestone to formally enter the main backlog. Okay,
but let's push back a bit here. That $3 billion reported backlog, that's audited, it's in the filings. This pre-backlog, which they're saying could be another $3 billion, maybe even closer to $4 billion, that's based on management's view, right? It's not quite as concrete yet. Did they give any specifics to really make people feel comfortable that this is locked-in work, not just, a strong pipeline?
That's a fair challenge. And yeah, it's not an official SEC filing metric yet, but they tried to address it by emphasizing the sheer scale of it. They explicitly stated on the call that this pre-backlog amount is currently larger than the reported $3 billion backlog.
Larger, wow.
Yeah, that scale alone kind of changes the risk perception. If it's bigger than the official backlog, it suggests a massive amount of secured work is already lined up. They also made a point of saying this strength exists despite having some unusual cancellations earlier in the year, which kind of suggests the underlying business momentum was maybe even stronger than people realized.
Okay, so the sheer size provides a kind of unprecedented visibility, even if it's not formally in the backlog yet.
That's the argument, yeah. It gives them confidence looking forward.
All right, speaking of looking forward, let's talk guidance. They raised the full year 2025 outlook. Revenue guidance got a bump, now $2.48 to $2.53 billion. And EPS raised too, $14.60 to $14.06.
Yep, reflects the Q3 beat and the strong bookings momentum.
And they gave a little peek into 2026 as well. Preliminary view is for low double-digit revenue growth.
Right, low double digits for revenue in 26. which sounds pretty good.
Yeah.
But here's where it gets a bit more nuanced. They also said they expect 2026 EBITDA to grow at a high single-digit pace, maybe a bit more. So EBITDA growing slower than revenue.
Okay. So revenue up low double digits, EBITDA up high single digits. Why the gap? Is this margin pressure finally hitting? Competition? Pricing?
Well, according to management, no. They were pretty clear they don't see pure pricing pressure as a major factor, especially not with their bigger pharma clients. The difference, they said, comes down almost entirely to pass-through costs.
Okay. The reimbursables, money that flows through them to pay for investigator sites, patient costs, things like that.
Exactly. Those costs that just pass straight through the income statement. They expect these to stay pretty high relative to history. They peg the range at 41% to 42% of revenue.
41 to 42%. That sounds high.
It is elevated. And it's driven mostly by the mix of business they're winning and executing on. Lots of faster burning, late-stage projects, especially in areas like metabolic studies.
So more complex, faster trials mean higher pass-throughs, which means that chunk of revenue has lower inherent profitability, even if the overall project is strategic.
That's basically it. It's not really margin erosion in their core service. It's more like a structural effect of the type of work that's driving growth right now.
And is this 41, 42% range the new normal, or do they see it coming down? What was it historically before this, GLP-1 wave really hit?
Yeah, it's definitely higher than historical norms,
Yeah.
but they do see it normalizing somewhat. They expect pass-throughs to peak in Q4 of this year, 25, and then gradually start coming down through 2026. So the takeaway is it's about mix, not pricing pressure. And this mix allows them to capture and execute on these really high-demand projects quickly, even if it temporarily makes the overall EBITDA percentage look slightly lower relative to revenue growth. They're prioritizing speed and scale right now.
Got it. And this whole performance, the beat, the bookings, the guidance, it definitely plays into that broader narrative, doesn't it? The idea that we're seeing green shoots, maybe even a full-on green flag for the biotech upcycle.
Absolutely. You connect the dots, right? We've seen biotech funding improving, M&A picking up a bit.
Yeah.
The XBI, the biotech ETF, has had a nice recovery since late September.
Right.
Medpace's results, especially the massive bookings, kind of confirm that this better funding environment is actually translating into real clinical trial spending, particularly for those small and mid-sized biotechs, which is really Medpace's sweet spot.
And a huge part of that spending and Medpace's success seems tied to their therapeutic mix, specifically metabolic studies, GLP-1s, basically.
Yeah, they said GLP-1 related trials make up about 2/3 of their obesity work. And here's a fascinating link back to that pre-backlog we talked about.
Okay.
Management specifically mentioned that the pre-backlog, that huge chunk of future work, is currently over-indexed in metabolic trials compared to what's driving revenue right now.
So even more of that future work is tied to this big secular trend.
Exactly. It secures a strong future revenue stream tied to something durable, and it explains why they feel confident talking about sustained double-digit growth despite the already high base.
Okay, operationally, though, handling all this growth, especially these complex, fast-moving trials, is the staffing there? Are they building capacity fast enough, or is there a risk they get constrained in 2026?
That's definitely the operational challenge, and they seem to be tackling it head on. They talked about accelerating hiring into 2026, specifically to support that sales forecast. Geographically, the biggest recent growth in headcount was North America, mainly the U.S., then Asia, with a specific focus on India, presumably for some offshoring and support functions. Europe and China were more stable.
So adding people in the U.S. and India seems targeted at handling those big late-stage trials.
It seems that way, yeah. Strategically put in the capacity where that pre-backlog suggests the demand is going to be heaviest.
Makes sense. What about the competition? Management mentioned clients are sometimes bringing 6 or more CROs to the table for bids now. That sounds intense.
It does.
If you've got 6 companies pitching for the same trial, doesn't that risk turning the service into a commodity? How does Medpace hold on to its specialized positioning and maybe premium pricing if the field is that crowded up front?
Yeah, that's the interesting counterpoint they offered. They acknowledged, yes, more providers are often invited to bid initially, which mathematically you'd think would dilute anyone's win rate. But they actually said their competitive win rate improved this quarter.
Improved, even with more bidders.
Yeah. Their argument is basically, clients might cast a wide net initially, but when it comes down to choosing, especially for complex trials in areas like metabolic or for mid-sized biotech clients who need a lot of handholding, Medpace's specialized model wins out. They seem to view the high number of initial bidders as maybe just noise, not a fundamental threat to their ability to win the work they're best suited for at their desired terms. Execution and expertise over just price.
Interesting perspective. Okay, and lastly, before we get to our favorite segment, capital allocation. Anything significant there?
Pretty quiet, actually. They bought back a small amount of stock, about 14,600 shares, for roughly $4.5 million in Q3. Very modest. Seems like the focus is squarely on investing in the operations, hiring, building capacity to handle that massive wave of work they see coming from the backlog and pre-backlog.
All right. Makes sense. Now let's transition. It's time for that part of the deep dive where we discuss ideas you should definitely, absolutely not act on without consulting a professional.
Indeed. Standard disclaimer applies loud and clear. This is purely for discussion, drawing only from the information in the earnings call materials we've just talked about. It is not financial advice. Please talk to your advisor before doing anything at all.
Okay, the setup is Medpace delivered a huge bookings beat, confirming reacceleration, massive forward visibility from this pre-backlog. What's the outrageous but plausible pitch inspired by only this print?
Okay, thinking purely about relative value based on this specific call. I'm pitching long MEDP, short the XBI ETF.
Ooh, interesting. Long the outperformer, short the broad sector index. Walk us through the thinking there.
The rationale is all about betting on superior execution, winning out over just general sector sentiment lifting all boats. The XBI has rallied, yeah, partly on hope and improving funding vibes. But Medpace just delivered concrete, verifiable operational proof points. That 1.20x book-to-bill, the pre-backlog being bigger than the actual backlog, conversion rates improving into the mid-20s.
Right, the execution metrics.
Exactly. So the bet is that Medpace's specific focus, particularly on those small to mid-sized clients where they excel, and their proven operational discipline, that 22.5% EBITDA margin, the strategic hiring allows them to generate alpha relative to the broader index. Especially as the market maybe shifts from just a relief rally in biotech to focusing on who can actually deliver on the pipeline. You're betting Medpace executes better than the average XBI component.
Okay, makes sense from the call details. What's the tripwire? What do you need to watch to see if this idea holds water?
It really hinges on two things directly from their KPIs. One, they need to keep delivering net new awards of, let's say, $700 million or more per quarter. They need to sustain that booking momentum.
Maintain the high bookings, got it.
And two, that backlog conversion rate needs to stay strong, somewhere near those low 20s percentages they just hit. If bookings slow down significantly, or if they suddenly can't convert that backlog efficiently, then the whole superior execution thesis starts to wobble.
Understood. So continued high bookings and efficient conversion are key. That's definitely a trade idea rooted firmly in the calls narrative. Okay, to wrap things up then, Medpace Q3 really felt like a turning point print, fueled by those record bookings, that incredible visibility from the pre-backlog, and raised guidance that sets them up for solid low double-digit growth into 2026.
Definitely a narrative changer. And maybe one final thought to leave you with, connecting some of these threads. We talked about the pre-backlog being heavily weighted towards metabolic and GLP-1 work. And management is guiding for sustained double-digit growth well into 2026, powered by converting that work. So what does that implicitly tell you about how long they expect these massive high-profile metabolic trials to actually run? It suggests this isn't just a short-term boom. It implies a multi-year clinical development timeline for this therapeutic area, needing sustained operational focus from CROs like Medpace, potentially well into the back half of this decade. Something to think about.
A very interesting point about the implied duration and the long tail of this trend. Definitely something to mull over as you look at the whole sector. Thanks for joining us for this deep dive into Medpace's Q3. And remember, one last time, nothing we discussed constitutes financial advice, just analysis based on the source material. We absolutely encourage you to review it yourself.